In this video, we're going to have a look at the balance sheet and in particular ratio analysis, a couple of ratios as measures of financial stability. Measures of financial stability include two types: liquidity in the short term and solvency over the long term. So in the short term, when we are discussing liquidity, we are interested in current assets and current liabilities. And those assets and liabilities are assets and liabilities where resources flow to and from the entity within the accounting period, normally 12 months. So that's what liquidity is about. Cash flows within 12 months, meeting our cash flows. Whereas solvency looks at assets and liabilities and equity over the longer term and external funding. A definition of liquidity is how quickly an asset can be turned into cash. Cash, of course, is cash. That's what's called liquid. And other forms of other assets, how quickly they can be turned into cash. Shares, for example, can be very quickly turned into cash. That's a short-term investment. Other assets like debtors and inventory, they can be turned into cash reasonably quickly. Debtors might take 30, 60 days for that to come in, sometimes 90. Whereas depending on the type of business, your stock, your inventory, that can take anywhere from 30, 60, 90, 3, 6, 9 months for that the inventory to be converted into cash. We're going to look at two ratios and working capital. Working capital is simply your current assets minus your current liabilities. And so your working capital is your cash that you have left behind after you deduct all your current liabilities from your current assets. Okay, for example, if we have over here, we've got our current assets, bank, debtors and stock. So altogether there, we've got $6,000 worth of current assets. And over here, we've got $3,000 worth of creditors. So deduct these creditors from our assets, current assets, and we have working capital of $3,000. That's what it means to have working capital after you deduct all your current liabilities from your current assets. Then there is the working capital ratio. So this is the ratio of current assets divided by your current liabilities. And it is defined as the ability to meet short-term commitments within the next 12 months. And it is recommended that this ratio might be about 1.5 to 2 to 1. Did that make a lot of sense? So somewhere between 1.5 to 1 and 2 to 1. So you want at least 1.5 times your current liabilities in current assets. If you divide all your current assets by your current liabilities, you want a figure of about 1.5. And that's what's called covering your current liabilities. To have cover, to have enough current assets to cover your current liabilities, because your creditors will come knocking if you don't pay them. They will want to be paid the money that's owed to them, and as good corporate citizens, we have an obligation to pay our debts. Okay, so never mind the good corporate citizen business. As business people, we have an obligation to pay our debts. People need to get paid. That's their right. And so we need current assets to be able to do that. Cash, debtors, and inventory. But you don't want so many current assets that you've got idle capital. Business people are innately risk takers. That's why they're in business. Entrepreneurs are risk takers. They want to get as much cash as they can and invest it, as much of that as they can, and leverage that up. And we'll discuss leverage in a moment. But you need enough liquid assets to cover your current liabilities. And you don't want too many, because if you had too much cash lying around, well, then it's not being used productively. So let's have a look at the working capital ratio. If a working capital ratio was to be below 1.25 is to 1, and we'll have a look at calculating some of those in just a minute. That would be considered unfavourable. Now, before we said that we'd like it to be 1.5 times is to 1 at least, or even up to 2. But as it gets down below 1.25 is to 1, that's considered unfavourable. And when we're at that unfavourable level, we need to take remedial action. And remedial action could include, you need to increase our revenues and decrease our costs. That's part of the business operations. We might need to convert some short-term debt into long-term loans and get it off that out of the current asset situation, shift it into a long-term loan. Current liabilities, that is. A capital contribution from the owner. The owner can, if you're a bit short on cash, you may need to inject cash into the business. We can liquidate stock. A lot of businesses have a stock liquidation sale, and that's either they need to clear it out or they need to improve this ratio to get their current assets up, their current liabilities down, and say they will have a stock liquidation sale to get some cash, convert those inventories into cash to improve their cash flow. You will need to be diligent in following up your debtors, people who owe you money. Don't leave it to them. Give them an invoice. It's payable within 30 days, and as soon as that 30 days is up, give them a friendly reminder that it's overdue. Don't let them go, because some people will take that leniency and they will pay someone else rather than you. So be diligent with following up debtors. Another thing you can do is offer discounts for cash. When you make sales, someone may say, might like to put it on credit. We might offer them a discount for making cash sales, and this can help and improve our working capital ratio. So let's do a calculation here. Here's an exercise 21. Here is Sunny Enterprises. Sunny has current assets of 75,000 and current liabilities of 60,000. And the working capital ratio is current assets divided by current liabilities, which is 75,000 divided by 60,000, and this gives us a working capital ratio of 1.25 is to 1, which is okay, barely. Okay, it's at the margin, that's okay. Zebra Industries, on the other hand, has cash, debtors and inventory of 5, 20 and 50,000 and has creditors of 90,000. So we're going to do a little sum here. Current assets, cash, debtors and inventory, add them all up together. 75,000 divided by 90,000, here it is here, gives us a working capital ratio of 0.83 is to 1. Okay, that doesn't sound as good, does it? Let's have a look at that and see what all that means. Let's discuss having a liquidity problem and see if these guys have a liquidity problem. A liquidity problem is where your current liabilities are greater than your current assets. Now let's make it a working capital ratio of less than 1.1 is to 1. So we're suggesting here that if we've got current assets slightly larger than your current liabilities, where your working capital ratio is 1.1 is to 1, that's considered insufficient. That's considered that you will have a liquidity problem. Okay, we can't count on all our debtors coming in, and we can't count on them all coming in the next 30 days when we owe our creditors. So this is an accounting definition. A working capital ratio less than 1.1 is to 1 is considered having a liquidity problem. Okay, and this is where we would say remedial action is required. Sound liquidity is where current assets are greater than current liabilities. The business does not have working capital. I think it's supposed to say there does not have working capital issues. It does have enough working capital to cover all its short-term liabilities, and it should be able to pay short-term debts when they fall due. And we could say here that no remedial action is required. So what observations can be made about the working capital ratio of these businesses? Sunny Enterprises has a working capital ratio of 1.25:1. What does that mean? That means the business has $1.25 to cover every dollar of short-term debt. What does this say about liquidity? We can say this business has sound liquidity. Can this business meet its short-term debts? Yes, this business should be able to meet its short-term debts when they fall due over the next 12 months. Is remedial action required? No, no remedial action is required for Sunny Enterprises. Let's have a look at Zebra. Zebra's working capital ratio is 0.83:1. What does that mean? That means the business has only has 83 cents to cover every dollar of short-term debt. What does this say about liquidity? A liquidity problem appears to exist because it's less than 1.1:1. What does this mean for the business? This means that the business will have great difficulty meeting its short-term debts over the next 12 months when they fall due. Is remedial action required? Yes, remedial action is required for Zebra Industries. In summary, regarding working capital ratio, you need to know the working capital ratio, which you can get from the handout that you get. There it is. That will have the working capital ratio on it, so there's no excuse for getting that wrong. Do the calculation. Then you need to interpret your findings. What does it mean? For example, 1.5:1 means you have $1.50 to cover every dollar worth of short-term debts. Is there a liquidity problem? Is the ratio less than or greater than 1.1:1? If it's less than, then yes, it does. If it's greater than, then no, it doesn't. Can the business meet its short-term debts over the next 12 months? Say so, if it can or if it can't. Is remedial action required? Say so. And know what a whole bunch of remedial actions are.